Hi, good day for everyone. Today is the second day of our education for real estate in Dubai. And we are now in the office of Developer Beyond. Incredible place, not just because we have here the only project in Dubai with forest, but because we are always located here in very nice marina. And from this side, we can see the islands where they have property already and the new project that we will sell for you. So this day, we would not speak about all Dubai. We will speak about investors, about how they are making money in Dubai, why they are picking specific projects, and what are they calculating to make sure that they will have profit. So let me know if there are any questions in your comments. You can text me in WhatsApp, Instagram, or even here after Zoom in our group. And now, Rabena, she will continue and tell you what our investors are making here in Dubai, why they are choosing this incredible place to call it home, and why they like investments in such an area. Lisa Forrest.
Good afternoon. This is Rowena from Fair Opportunity Real Estate. This is day two, okay? We were going to talk about how investors think, not just to buy, and the 2026 project selection blueprint. Welcome to day two. Yesterday, we cut through the market noise. Okay, we saw that Dubai 2026 is driven by fundamentals, not just hype. But now comes the hard part. With hundreds of projects launching, how do you choose? Not as an emotional buyer, swayed by a sleek agent, but as a strategic investor. Today is about education. We're pulling back the curtain on how sophisticated investors evaluate opportunities. We'll move beyond the sales talk and break down the decision-making framework. Because in this market, the difference between 30% ROI and a costly mistake comes down to how you think. So let's begin. Number one, the Trinity of value. Location, building, not equal developer. The biggest mistake, treating these three as one thing, which is not. They are separate layers of risk and reward. You must analyze it independently. Okay, so layer one, that is location. It is the immovable macro bet. This is your macroeconomic bet on a city sector. Is the government investing billions here? Look at Dubai Urban Plan 2040. The megaworth corridors are clear. Dubai South, the Aerotropolis, and Dubai Creek Harbor. They said the new downtown. And extended Dubai Marina to Jebel Ali coastline. It is a great location, has an infrastructure being built for the future, not just promise. Let's check the RTA's public transport map. Is there a metro station under construction within the 800 meters? That's tangible value driver. So location is about future jobs, connectivity, and community density. Layer two, the building, the physical asset. This is your micro bet on quality and livability. A great location with a poorly built tower is a bad investment. You're not just buying views, you are buying materials, maintenance, and management. So, investors now scrutinize. So there are specifications. Are they using VRF or what we call the value refrigerant flood flow? Sorry, individually metered efficient. VRF is actually individually metered efficient, or the old chilled water. What's the cladding? Has the ESC or the enhanced security and safety compliance rating been published? So these are actually some of the specifications. 2, facilities to units ratio. A 500 unit tower with one tiny pool is a future problem. Look for a healthy ratio. A 2025 Knight Frank report highlighted that the buildings with superior amenities or like co-working spaces, concierge, smart tech was achieved 15% to 20% rental premiums. So the plot size and the layout as well affects. A tower on a small plot means tiny common areas. Look for generation plots ratios. These are all specifications that you have to look when you are buying. Layer 3, the developer. Are they executing well and the trust factor is there? This is your counterparty risk. A fancy brochure, which every developer is doing now, it is meaningless without a track record of on time or the spec delivery. Let's say the track record. Don't just look at their best project, like what the brochure is saying or what the picture is telling us. Look at their old project rather, because this will tell anything, everything. Go visit it if it's possible. How was it aged? How is the management? Talk to the residents just for you to understand what it's all about in this building or in the community that you're buying. Financial health. Are they publicly listed? Check their financials. Though they have a history of launching and completing projects, or just launching and launching, this is sometimes a very dangerous thing actually. So you have to check all those things, all facets before buying any property. You also need actually to check the post handover service. Do they really have a dedicated owners association management arm? Or the biggest hidden cost in Dubai real estate is poor building management after hard handover. The rule: HR developer, B tier location, greater than C tier developer, plus HR location. You can actually fix building interior, but you can fix a bad developer or move a bad location. So these are all the factors that we need to consider when buying property. Why? Number 2, why price per square foot is a trap? The exit strategy is king. Agents love to sell your price per square foot. It's simple, comparable, and feels scientific. But for an investor, it's often a dangerous distraction. You don't invest in a square feet, you invest in a future exit. Number 1, define your exit before you enter. Are you? That's a question. The flipper. This means pre-completion. Your exit is a secondary market before handover. Your analysis is 100% about project hype, payment plan attractiveness, and absorption rate in the segment. This is high risk in 2026. One more thing is the landlord, which is the post completion. Your exit is a future sale to an end user in 5 to 10 years. Analysis is about rental yield stability, tenant profile, and long-term capital appreciation drivers. Now, the end user for the future use. Your exit is your own occupancy. Your analysis is purely on a lifestyle curve versus value. So the first one a while ago is define your exit before you enter, right? So the second one is the calculations that matter more than price is square foot. The YOC, or we call it the yield on cost, expected annual rent versus total investment costs. This includes your down payment, all installments, and DLD fleece. A cheaper PSF apartment with a high service charges and low rent gives a worse YOC, or yield of cost, than a slightly more expensive one with better rent. Capital deployment efficiency. A 2 million AED studio might have a great PSF, but a 2.2 million AED one bedroom in the same building might rent for 30% more and attract a much larger buyer pool on resale. The slight higher total cost gives you a vastly better asset. The liquidity premium. In established areas like the Spring or downtown, the price PSF is higher, but so is the transaction volume. According to Property Monitor transaction data, Q1 of 2026, prime established areas see 3 times the sales volume of emerging areas, meaning you pay a premium for future exit liquidity. That's a smart premium. Number 3 is high project versus smart project, or the 2026 telltale sign. Let's get practical. How do you tell them apart of a launch events? The high project, all seasonal stake as questionable. Marketing over substance. The launch is at a 5-star hotel with celebrities. The rendering are fancies, flying cars, holographic concierges. The brochure says luxury 100 times but has a 0 technical specs. The world's first gimmick. The world's first NFT integrated facade. Cool, right? Does it make the building more livable or valuable? Or is it cheap tricks to justify a 30% premium? Next is a payment plan. As the main feature, 0% until 2029. This is a cash flow risk, not a value proposition. It's designed to bypass your due diligence by making the entry feel painless. The developer is essentially your banker. Vague location pin. The Dubai Canal. It means it's 3 kilometers away with no view. Between downtown and Dubai Marina means It's in a traffic clogged inner road with no identity. The smart project. Substance with polish. Clarity on the fundamentals. The presentation includes master plan approvals from RTA, VEWA capacity letters, and clear architectural plans. Rationale for being, so it solves a clear demand gap. For example, we are building mid-market, high-quality, two-bed apartments for young families in Dubai Hills Estate, where current supply is 80% villas. That's a thesis. Realistic amenities, while a focus on parks, jogging tracks, pet areas, and community retail. These things people actually use daily, right? And one more thing, transparent developer track record. They show you the completed projects and invite you to visit. They have a clear post handover management plan. So that's the case number one. So case study compare two 2025 launches. Project A, it's a hype. It's in a vague new area with celebrity tie-in versus Project B by listed developer extending in existing successful community like Arabian ranches. So that's the Project A hype. Project B's secondary market price is up 18% post-launch. While Project A is struggling to find buyers after the initial flurry, the smart project builds on proven demand. Number 4, the off-plan paradox. Why some work and some don't? Off-plan is the heart of Dubai's market, but it's misunderstood. It's not inherently good or bad. It's a tool that works under specific conditions. What are these conditions? When off-plan works, you're buying a scarcity in a proven location. The developer is launching the last few plots in Dubai Marina or the final phase of a sold out community. You're paying for the address and the building is almost a bonus. The price reflects a discount to future value, not a discount to today's market, but a legitimate discount to the estimated completed value. This requires modeling. Completed value equals current comparable prices plus estimated market growth over build time minus discount. If actually the launch is within 15% of today's prices for similar ready property, the risk reward is poor. The developer uses escrow and construction is visible. You see the steady progress. Your money is protected in the project's RERA escrow account, and drawdowns are tied to milestones. You are not funding their land bank. So when off-plan is